Hello to everybody. Welcome to our panel, Regulating Innovation, the Moving Target of Insurtech TechTalk. We are going to wait for a little bit just to give a chance for everybody else to join the panel. But before we start, I do want to thank all of our wonderful panelists who agreed to come and share their opinions and experiences in their respective industries. I do want to say thank you to a wonderful company that I work for that organized this event, ELEKS Technology. Thank you to our wonderful marketing that made it all happen. Today we're going to talk about the challenges and opportunities with regards to innovation, the regulatory landscape, and what does it mean when we are thinking to innovate our systems and when we're setting a goal to disrupt the market. Today we have people representing different industries and different companies, including an expert from the regulatory side and insurtech experts. And so let me present each of them one by one. So we have Anouar Ouali Alami. She's based in Europe and she's the founder and CEO of Anfa Square. We have Clive Thompson, who is leading the digital insurance solutions in Trov, one of the most well-known insurtechs on the market. Eric Nordman, who is a regulatory veteran who knows more about regulation than any of us over here. We have Klaus Sonnenleiter, who is the CEO of Luftronix, a company that developed a cutting-edge technology for drones. And by luck, he is also a CTO of ELEKS. And we also have Les Williams, a co-founder of Risk Cooperative, and a chief revenue officer of the brokerage, who is spearheading a lot of innovative projects with the Risk Cooperative and other institutions in the United States. So ladies and gentlemen, if I may ask you to present and say a little bit about yourself, about your experience, what brought you here, and what brought you where you are today. I will start with ladies. Anouar?
Hi, thank you, Layla. So yeah, my name is Anouar Ouali Alami. My career was mainly in aviation, 18 years of ground handling, let's say, in Qatar Airways, Royal Emirates, and Avia Partner Group. Today, I'm the CEO and founder of Anfa Square, a company dedicated to support other companies when it comes to digitalization and business transformation. We also do implement innovation framework across all departments of the companies. And since we are specialized also in aviation, we provide consultancy on resource management and specific aviation IT landscape. I worked already with ELEKS before in a very nice project called Sunrise. So it was really nice. It was a part of a big framework of digitization. And I'm here obviously to provide an overview from an airline perspective on the innovation framework, but also on the different, let's say, technologies that are impacting the landscape of aviation.
Thank you, Anouar. Eric, it's your turn.
Well, good morning, everyone. A little bit of my background. I am retired from the National Association of Insurance Commissioners, where I worked for 27 years in a variety of positions. Probably the most notable are as a division director of the Regulatory Services Division and as the director for the NAIC's think tank, which is called the Center for Insurance Policy and Research. Before I came to the NAIC, I spent 13 years working as a regulator in the state of Michigan. It was called the Michigan Insurance Bureau at the time. It's something about financial services now. But I did spend 13 years there. primarily working in reviewing rate filings and policy form filings. So I've got about 40 years of regulatory experience. I have a CPCU. I have a certified insurance examiner and a market conduct manager designation from the Insurance Regulatory Examiner Society. Turn it back over to you.
Thank you, Eric. It's a pleasure to have you at our panel today. Clive, would you mind to share a few words about yourself?
Yeah, thanks, Layla. Nice to meet you all. My name is Clive Thompson. My background before joining the InsurTech space is I worked at major insurance companies for over 10 years. And over those 10 years, what I saw is not a lot of change or necessary innovation within the technology used to assess and price risk. So about a year ago, I decided to make the pivot and to join the InsurTech revolution, where we are either digitizing or changing how people think about risk. For those of you not familiar with Trov, Trov is one of the longest standing insurtechs. It's an 8-year-old company, which is funny to say that something 8 years old could be one of the longest standing companies in the space. And we specialize in changing the new ways or ensuring the new ways people live, work, and move through the world.
Wonderful. Thank you, Clive. Les, it's your turn.
Hey, good morning, good afternoon, and good night. I know we have a lot of people that are joining us from around the planet, so thank you, Layla, for having all of us. Les Williams, I'm co-founder and chief revenue officer of Risk Cooperative. We're a very unique risk management and insurance brokerage firm. We do the traditional risks, i.e. Employee benefits, also property and casualty coverages like your workers' comp, your general liability insurance. But where we specialize in is unique risks, cyber insurance, for example. We also do out-of-the-box risks like kidnap and ransom insurance, as well as political risk insurance for companies that are looking to grow their presence overseas. I have an interesting background. I started, and I'm sure I probably ran into Eric at one point in Michigan. 20 years ago, I was an engineer at Ford Motor Company, mechanical engineer. Spent 3 or 4 years in Michigan before going to business school and then working for IBM as a technical sales consultant. And one of the things I've been doing, even though my background is not traditionally in what you would say a pure insurance world, it was in risk management. I was always solving problems because that's what engineers do. And at most companies, no matter what your degree is in, you're solving problems. And so when I helped co-found Risk Cooperative with Andres Franzetti and Dante Disparte, they had come from another mid-tier insurance brokerage platform. And they said, look, let's really solve some hard to place nasty risks. Join us, Les, because your background is an engineer. You like tinkering and inventing and creative things. We see how this insurance has been doing things for a long time the same way. Nobody innovates that way. So 5.5 years ago, we jumped on this rocket ship and we're still riding it. I'm a certified risk manager, CRM, and really look forward to talking to the group today and as well as the attendees.
Thank you very much, Les. Klaus, the floor is yours.
Thank you. So interesting, Les. I thought I recognized your name and your face from the last prep call. We ran into each other before at IBM. I'll get into that later. So thanks for the intro, Layla. As you pointed out, I have a dual role to cover here. At Luftronix, we make scanning equipment for commercial airliners, and we fly drones around the aircraft with a high-resolution camera so that we can radically shorten the inspection window and get the aircraft back into circulation. So that's my role at Luftronix. In the meantime, at ELEKS, as the CTO, I'm typically involved in the technology needs that our customers have, and those customers include some very large insurance companies, all the way through the spectrum down to small insurance startup companies. That's pretty much what I do every day. Thank you.
Thank you, Klaus. Okay, well, without further ado, I would like to delve into the topic of our conversation today, which is the regulating innovation and moving target of Insurtech. And I would like to address this question to Les. However, everybody is very welcome to comment on that. But during the Eisenhower era, going back to the 1950s, Americans achieved a very high level of prosperity. And of course, I mean, if you think about it, you know, after surviving the Second World War, people, you know, got these amounts of money they wanted to spend, and insurers back then found an opportunity. So a lot of, you know, products were created in the 1950s, and insurance became the first to essentially adopt new innovative technologies. They invested into their systems. They, you know, built in-house processes and underwriting systems and whatnot. And so what happened was that a few years later, a recession hit. And then insurance companies became very reserved, and all of their funds suddenly were not spent on innovation. So instead of actually innovating and upgrading, they were adding bits and pieces of technology to the legacy systems that eventually led them to become a dinosaur of technology, even to this day. And so thinking about crisis and thinking about recession, you know, right now we're going through a very tough time, especially for insurance companies. How do you think the pandemic and this crisis, economic crisis, will affect insurance companies in regards to adaptation of new technology and investment into those projects?
Thanks so much, Layla. You know, and this is one of the reasons, again, why we did form Risk Cooperative, and I'm sure why folks like Clive founded Trov as well. We've been doing the same boring things for so long, it's not even funny anymore. When we talk about growing, you know, protecting revenue streams for insurance companies, I'm also going to talk a little bit, Layla, about cutting costs, because that's something we've all been reading about in every single major news publication and every single news outlets about what these insurance companies are doing. But what we have seen is massive consolidation. So that's one big way that insurance companies are protecting their revenue streams. Aon, the behemoth broker, they bought Willis recently. Marsh bought JLT. We were in the middle of doing some work with JLT out in London, and then all of a sudden phone numbers started changing, and we were all scratching our head at Risk Cooperative, like, what's going on? So that was in 2019. More consolidation will come. These insurance carriers and brokers are protecting their revenue streams by making sure that competition isn't there, right? So you can argue whether or not that's good or bad for the consumer. We'll get into that a little bit later. But also, they're cutting their costs by streamlining a lot of their back office operations. Unfortunately, we all know that jobs do come with that and some of that cost cutting measures. And we've slowly started seeing some of these costs being cut from that perspective. We think this may speed up even more. But another way that a lot of insurance companies and carriers are really protecting their revenue streams is by buying and investing in other insurtech companies. A lot of them realized, we all remember Amazon, Google, and Berkshire Hathaway, they formed this healthcare captive where they're saying, look, we're going to self-insure. We're going to, you know, the three behemoths with all their hundreds of thousands of employees, they said, we're going to manage our own healthcare costs. And I know that the Big Blues and United Healthcares of the world, they're shaking in their boots, and they should, because more companies, you're starting to see more companies do that as well and say, look, we can just self-insure to save money without having to go and you know, pay these premiums. And so as more companies look to do that and be more innovative, we think at Risk Cooperative, and I think you're going to see a lot of these insurance companies buy some of these other insurtech companies or invest in them, because a lot of them are so big, they don't know how to be creative on their own. And it's not a knock on them personally, it's just the way the industry has been. I'll give you two examples. A good friend, James Hobson, he graduated from business school with me. He's the CEO of Attune Insurance, online marketplace where brokers and agents can go and get quotes like this and get something turned around very quickly, whereas beforehand, you know, working with a broker does take a matter of days. Another company is called Surround Insurance. And by the way, James Hobson Company, AIG, is an investor in them, so that's one example. Surround Insurance, my good friend Kate Terry, amazing business model. It's a monthly premium-based insurance model where they focused in on property and casualty insurance coverage for renters insurance and auto insurance. Again, between millennials between the ages of 22 and 26 is their main focus. So I think you're going to see a lot more insurance companies just buy or invest because they know they have to keep up with some of the innovations that are going on. Layla, what a lot of people don't talk about, and it's now starting to come out in the news, is several insurance companies have actually been saving money, and the insurance industry has been saving money, not just in the refusal to pay claims for business interruption, but also folks aren't driving cars. All of the major P&C insurance carriers have been saving money. They have been giving some of that money back to consumers, but still, when folks aren't driving cars, claims are going down. Guess what? You have all this extra cash on hand. Same for the healthcare industry. The non-elective procedures have been pushed off in many cases till 2021 because people are scared to go to the doctor to get things done. So they're able to actually save a lot of money and from a cost perspective, which is affecting their bottom line by not having to pay any claims out. The last thing I'll say on this is what we see fundamentally happening as insurance companies are looking to protect their revenue streams and cut costs. What we're seeing in a post-pandemic world is, and this again gets into more of the areas of some of the regulatory things that my good friend Eric is probably going to get into, but what does it mean? What does the term business interruption mean? This business interruption insurance concept came about in the early 1900s, where a lot of manufacturing companies had expensive boilers. God forbid one of those things caught fire and blew up. You could be down for a number of weeks or months. So physical damage is linked to business interruption insurance claim payouts. So what a lot of people are saying is, look, a lot of insurance carriers are saying there's no physical damage. This is a pandemic. It's a virus. And so now we're starting to peel back the onions where different companies are now banding together. And this has been in the Wall Street Journal recently with a lawyer leading this charge. He's based in New Orleans, saying, you know, a virus does have physical damage because it's on my tables and my chairs, and it's causing customers not to want to come in and use my product. And so what we're going to see is hopefully the regulators stepping in and making sure that business interruption insurance will cover at least some of this damage that's been taking place across our industry from an economic perspective.
Let's hold that thought. I will go back to the business interruption insurance later, but I want to go back as well to the to something that you've said about the consolidation. And Clive, let me bounce this question off you. So, have you seen, as you know, as a leader, as also somebody who's working for InsurTech, have you seen anybody or any large companies approaching Trov with requests or desire to acquire your book of business? I mean, and Trov as InsurTech, since it's such a successful company. And also, I would really like to know how the pandemic affected your business model. If there are any changes that you think the company is going to implement in the near future to sort of either fight back or just evolve.
Yeah, sure. Thanks. That's a great question. I'll build on Les's comments that it's certainly true that many large insurance companies are sort of future-proofing their business by investing in InsurTechs. Trov has many notable large names as investors and on our board. So certainly we're a part of that trend, and I think you see that pretty much universally across the InsurTech space. In terms of our own experiences of acquisitions, I don't think there's anything notable in the public domain yet of a major InsurTech being acquired by a major company. But that doesn't mean it's not ripe to happen. This is certainly a time where we're seeing a flurry of mergers and acquisitions. I would comment on, in terms of how has Trov's business been affected by the pandemic, in a couple ways. The first thing is, one of our core businesses is we enable or provide insurance solutions for mobility, major mobility companies. So the Ubers and Lyfts in the world, Waymo is a notable client of ours. And if you look in that space, it's very similar to the insurance space. Postmates was recently acquired by Uber. We saw also Uber take a large position in Lime. So there's an incredible amount of consolidation occurring there. But the second thing that's incredibly exciting is the number of entrepreneurs entering the space. So as we've seen changes in consumer habits, and what people are demanding out of transportation, I think the most notable thing that consumers want are two things. One is safety, and the second is choice. So if you think about what happened in the UK recently, London made a very brave step into allowing e-scooters to be legal in the roads. They've also designated an area that doesn't have cars. That's drastically going to change an already upward trend of urban mobility. And so from our perspective, there's one at kind of the top layer, there's this incredible consolidation and trying to grab market share, very similar to Les's comments about what's happening in the insurance space, and maybe Uber's trying to do the same thing. But also you have the small guys emerging. And I think also there's a huge need and desire of a rising tide, as everybody has different preferences, different perceptions of what they want, what they're comfortable with. You're going to see all different types of mobility, beyond rideshare, beyond micro. We get requests for, motorized tricycles or, robotic delivery of pizzas. Really, it's everything runs the spectrum. And it's going to be really interesting to see what consumers really choose. From our business's perspective, our job is also the weird, the risky, the new, and finding those ambitious underwriters who really want to be a part of that. Because the other way that insurers future-proof their business is if they recognize that the consumer choice of how I move through the world is changing. The traditional, family home car, those premiums are going to start to come down, and those are going to be transferred over to a commercial policy and sold as an embedded part of this transportation service. So we're a part of that future proofing. It's a very exciting space to be in. And in terms of how our business changes is we have to adapt. And we are, as a small company, we get the benefit of being adaptable and being nimble and capturing a trend. But at the end of the day, we always have to partner with large insurance companies. And I think that's the other way beyond an investment, how the InsurTech stay relevant to the big established players.
Absolutely. Thank you so much. I think the fact that we are having Anouar and Klaus here on the panel is extremely important because aviation industry has been hit, it's the worst, truly. I mean, travel and aviation industry is in terrible condition right now. And so my question is, are there any lessons that we can learn from aviation industry? Aviation is first of all, we're talking about drones, right? It's a very innovative technology. It's AI. It's something that people are not really comfortable with yet. Now, when we're talking about ground handling or any sort of robotic automation used by the airlines to service their aircrafts, do you think where investment is going in the aviation industry, and do you think this is the time for the aviation industry to start investing into the new technology and evolve while everybody is quiet, and the number of customers decreased? Or is it a time when aviation industry decided to sit back and wait for better times to decide on the technology that they're going to go with in the future?
Yeah, that's an interesting question. And I think, honestly, the aviation industry is a great industry to learn from when it comes to recovering from disasters in general and from this one in particular. And not to spoil the results, but what you mentioned last, sit back and wait until it's over. I think the companies who do that are the roadkill of the future. And it's for a simple reason. If you look at how smart companies respond to crisis, it's a combination of two things. You will see them, first of all, button down all the hatches, make sure no water gets into the boat, make sure the boat is as lightweight as it can be, and as storm secure to get through the storm. Once that work is done, every single one of the companies who is smart and will come out later as a winner will create an attack plan. So that's step number 2 in any crisis management. You make sure that the boat can swim. Number 2, you make sure you can attack, and you look for vulnerabilities in your market. You look at other companies that are vulnerable at the moment, and translate it to the aviation industry. You look for the ones who might be acquisition targets, who might be going away, who might give up landing rights, and you're looking you're looking for an expansion plan, not for a shrinkage plan. So you'll see after this phase, consolidation, of course, but you'll also see unexpected new players who stick their head out and say, now we're attacking, and now we're going against the established players, and we're doing new things, and we're surprising everybody. And those plans are made right now, and they're both in efficiency, they're in expansion, and they are in how we can make an end run around all those people who have been lazy and have not been doing anything, or who have been cutting too hard. That too is a danger.
Right. Thank you, Klaus. Anouar.
Yeah. So I think it depends on which profile of aviation, let's say, company you are. So if you are an airport, this is the time of investment. I saw a couple of information, just shared that they for example invest in AI tools used for let's say tracking the services delivered at the ramp area. Aberdeen Airport just signed a contract with the software company dedicated for that now, which is interesting because then you see a lot of this trend for airports, some also for airlines, but very low, let's say, initiatives on investments from ground handling for a reason that we all know. It's the revenue model and the margins. Airports have more, let's say, capability to react, and they're quite, in fact, pushy for it when it comes to the innovation. They have already initiatives ongoing, and it's a continuity. While airlines and ground handlers are still struggling with with getting their customers and trying to have the liquidity, enough liquidity, help from government to react. I think aviation doesn't have a choice. I don't think that we have a choice as an industry, but to go for the innovation, like any other sector. Aviation, anyways, was there at the beginning when it comes to innovation. So I think now is the time to implement. Why? Because resources are there. They can do something else than probably waiting for the business to start again. And I know some of the software companies, they made their big contracts during COVID, which was quite surprising for me. I didn't expect it, but that's quite nice to see. So I think my position is, yes, aviation is going through a very tough time, definitely. But those who will recover are those who are really investing in innovation. They have already frameworks already set up, and they just continue their investments and also their processes of digitization internally.
Great. Thank you. That is hold that thought as well. Eric, I would like to ask you a multi-layered question. And so one, it's related to innovation. And so let's think about AI. And a lot of companies right now, especially those insurtechs, they're trying to implement AI. And of course, AI has a lot of layers to it, right? It can be anything from predictive modeling to chatbots to any sort of underwriting models that do not require human touch whatsoever, or to claims handling. Think about Lemonade or Snapsheet, for example. I'm really interested to know what is the standpoint, what is the position of regulators towards those insurtech companies that are trying to substitute traditional claims adjusting with AI mechanism. I mean, in order to become a claims adjuster in the insurance industry, you have to go through a certain, number of hours of classes and, take the exam. Whereas right now we're essentially handing this over to AI model. What is the position of the regulators on these type of insurtech companies?
Well, thank you for asking. While agents and brokers have to be licensed in every state in the U.S., there are 16 states that don't require a licensed claims adjusters. And almost every state allows company employees to adjust claims. So as long as you got somebody that's at the company responsible when things go wrong, I think regulators are open to having these new technologies involved in claim settling. Because it's safer for the claims adjuster. They don't have to get out a ladder and crawl on a roof. They can use a drone. They don't have to do that when there's a claim. They don't have to do that in the underwriting process. And people in this time of COVID-19 are fearful of dealing with other people because that's what the medical and scientific communities are telling us. COVID-19 is thus changing the process that people want. So people want less touch and are more accepting of, even taking their own cell phone, clicking a couple of pictures of damage of a car and shipping it off to a claims adjuster and having kind of a no-touch process where they get all of this. So they are embracing that technology, and as long as there are safeguards around it, because in the end of the day, the company's going to be responsible if things go awry. And a lot of claims, probably 90% of them or more, on the personal lines side can be settled that way. You don't get into huge disputes. It's a small number of cases that end up in litigation. So if you get a dinged up fender, there's no reason that you can't use the technology and artificial intelligence to get that claim settled efficiently, promptly. And that benefits not only insurers, but their customers who are probably going to be happier with it rather than waiting 2 or 3 weeks to have humans come in and get involved and make appointments for this, that, and the other thing. So the streamlining, I think, is one the regulators embrace.
Very interesting. And having worked for an insurance company myself in the past, I know how difficult and how heavily regulated insurance industry is in the United States. And so it's no surprise that a lot of insurtech companies, they are going to non-admitted markets for their products, right? Because it's much easier to start offering product with Lloyd's here in the United States than to go to all of the states and receive their approvals of filings and things of that nature. So do you think that, you mentioned that regulators right now, they are adjusting their view on how things are done in the insurance industry. Do you think that COVID-19 and this popularity of non-admitted markets will change dramatically how insurance is regulated in the United States in the next couple of years?
I don't believe it'll change that area. Traditionally, surplus lines, and maybe a little explanation of what surplus lines is for our non-US listeners might be helpful. Surplus lines is unique to the US because generally insurance companies are required to be licensed to sell business. There are certain circumstances where the regulators let them to sell it on a non-licensed or non-admitted basis. And the term for that is surplus lines. When you look at the size of the marketplace, the surplus lines market is about $50 billion. Now that sounds huge until you compare it to 2.4 trillion, which is the size of the US market. So now you're talking about what, 1 or 2%. Businesses in the US generally want to buy from an admitted carrier because they get a lot of extra assistance from the regulatory and legal community in dealing with them. So what happens is when there are exotic policies, people like to test them in the surplus lines market, but when they bring them into mass marketing, they generally want to have them brought into admitted companies, as you can see just by the numbers there. So it's while they're exempt from filing policy forms and rates as a surplus lines company, they still have to comply with state laws. So and there are also situations where there are diligent search requirements. So the states implement laws and regulations that require an insurance broker to either have 3 declinations from the admitted market before they can go to the surplus lines market. You don't see very much personal lines business written in the surplus lines market. It's other than a few coastal homeowners policies and some hazardous properties that are right near the water. You don't see much surplus lines activity. So most of the homeowners and auto insurance business, all the auto insurance business is written on an admitted basis because the state laws require that. So in summary, while it's a great place to test things and good for innovation, Eventually, they're going to come from the innovation surplus lines area over into the mainstream and get with an embedded market. And we're seeing that. A great example is cyber security policies, cyber insurance policies. Those started in the non-admitted surplus lines market, and now lots of mainline insurers are writing them as admitted coverage. So that will typically happen with any kind of contract that's out there that's new and innovative. Easier to test in the surplus lines market, but after it's matured a bit, it's going to move over to the admitted markets.
Interesting. Clive, question to you. Since the beginning of pandemic, the usage-based insurance and telematics became very popular. And do you see, could you share your experience at Trov? I mean, how, has it changed your business model again at all? And, what other technologies do you think would be the next step for Trov going forward?
Yeah, that's a great question. So I think taking even a step back out of the insurance world on what has the pandemic done for businesses in general is I think it's accelerated already a lot of trends that were happening, and namely mostly just the digitization of almost anything. So the way we work, normally we would all be on a panel in person somewhere, and instead we're enabled by a video call. The way our groceries are delivered, and also the way we think about how we hail a taxi. All of those things are enabled by insurance, or not insurance, but enabled by a digitalization of your interaction with a product, and something that we used to do in kind of a physical or analog way. And that's going to probably be here to stay, or at least enhanced in some way, even as the world loosens and opens back up. So with respect to delivery of insurance, I think insurance is ever more being demanded to be delivered in a digital format. The idea that you sit down with an agent face to face, and you go over your policies and your needs. Certainly that agent may play a role, but you might interact in a new way. Or in the case of usage-based and telematics, that might actually come to life in your own personal insurance, or it's going to come to life via as an embedded part of a service. So going back to earlier about how our insurance companies may be sitting on a lot of excess cash, it's because of the way the insurance is rated. So previously, insurance is just rated on a per vehicle basis. They estimate number of miles, and there's your annual premium, and it's locked in. And that was also true on the commercial side and the personal line side. But usage-based insurance has been more and more in vogue. And I think one of the things that the pandemic has done, digging a little deeper, is this has accelerated or highlighted the benefit of usage-based insurance. A lot of fleets had to go down for an entire quarter. I think the other thing that we talk about at Trov a lot is usage-based is just maybe a mechanism of rating per mile, per unit of time. But there's another extra bit to it, and that's the context. And all of a sudden, everybody who had a vehicle, whether it's a business or a person, wanted to use it for something else. If you want to use it for personal driving, well, maybe now I want to pick up some extra income and become a last mile delivery driver. Well, that's a very different type of insurance product. And the other thing is, you might be using them seamlessly throughout the day and jumping between, I want to go pick up my kid from school. And then also maybe at a different time, I want to be delivering some packages or some groceries. So as you're flipping between these instances, you're on different platforms, you're using different use cases, and you need the insurance to be dynamic. And if it's not dynamic, then you have a coverage gap, and that's a problem for the consumer. So I think along the lines of, is this trend here to stay? I think that the answer is a resounding yes, that businesses have woken up. We see it in our, as we see our inbounds, people are asking us more and more about on-demand insurance, context-based. Its benefits are now clear, and how an annualized singular policy, yes, you can get a rebate, but there's also an element of trust. Was the rebate enough? Does it align with how much I personally use my car? And technology can enable the exact measurement of that, both for a business and a person. And I think it's also key not to forget about, how you actually interact and get the insurance, and can you see it in an app? Can you see it in the same way that we're being accustomed to as consumers through almost any other way we interact with the world? That has to also occur. And I think that's what's really exciting about this conversation, being part of the InsurTech space, is we're really helping to partner with the insurance industry. I think that's also key. The InsurTechs aren't always here just to simply compete. We're here to partner and to help that transformation happen in the post-COVID world.
Absolutely, thank you, Clive. I do have a question to all of the panelists as well, because right now there is a lot of speculations about utilization of psychometric data. So, for example, there's a startup company that is called Pinpoint. I came across the company in Silicon Valley a couple of months ago. And so essentially they are providing their raw information, raw data to insurance companies, and essentially empowering them to understand human behavior. So unfortunately, I don't know the exact mechanism, but apparently it just, so pretty much if you are using your standard underwriting model, you also have an additional tool that tells you about the patterns of behavior of your customers. Now, let's step back and look at China. Right now, they've developed the technology that is called Brain. It's one of the most innovative and wonderful examples of AI. And at the beginning, so it utilizes not only predictive modeling, and they went through the entire cycle: deep learning, transfer learning, and then reinforcement learning. That is essentially the technology is mimicking the way humans are learning based on their experiences. And so right now, this Brain technology, that is AI-based technology, is regulating. First, it was regulating traffic in Hangzhou, in the largest city in China, and then one of the largest, I'm sorry. And then right now, the Beijing airport actually signed an agreement. And so this technology is right now regulating the traffic and essentially customer behavior and customer experience in the airport itself. And again, I mean, we can talk about regulations there and here and the differences. We all pretty much know that, US and Europe, there might be more regulated. But I do want to hear what do you, Anouar and Klaus and Eric, think about utilization of such technology if we take a step forward and truly explore the potential of AI in, going from regulating the airport traffic to AI-powered underwriting, and to allow the AI to learn on its own experience and predict the behavior of a business or a human before they actually make that decision themselves in the insurance industry.
So I think probably I can continue on the point of the AI systems used in the ramp. So in this case, I think I can share the name of the company, Asaya, who is using cameras at the airports to scan what's happening in the ramp, get the data. So, for example, if there is a pushback in there or a catering ground service equipment, and then obviously with their engines, they can decide or transform this data into meaningful information that could be used by airports, by ground handlers, or by airlines. Most of it is impacting, in fact, the revenue for ground handlers, which is interesting because we don't have the luxury in ground handling to lose the revenue. So this is quite interesting, I think, application of AI on ramp. This is the first, let's say, software in aviation targeting this particular issue of revenue. The other part, which is more related to behavior, okay, I think, how can I say it? I mean, it's quite a tough discussion on this point, because we know that customers are irrational. So in terms of decision making, we are irrational as people. So we think we know, we think we have our own rationale, but reality is, I mean, we are irrational, and using data to predict this irrationality with the biases that goes behind in the AI, it's still to be proven, So I would say it is nice to see, I think, some of the application of it, but we need to be careful, because today, I think there is a whole field dealing with this, which is called behavioral economics, which is exactly, the science of decision making by customers. Why customers are taking these decisions. By the way, when you do surveys, you don't get the behavior of the clients, so you get something else, and you end up taking other decisions. One example of this is the Red Bull. I don't know if anybody of you likes Red Bull, but the survey at the beginning of the launch of the Red Bull, was awful. It was very awful. It was like the worst, drink that ever has been tested by a customer. And guess what? It became really a competitor of Coca-Cola. And the explanation of that is that, in fact, we as human, the bad taste is linked with medicine somehow. So we perceive it as something good because it's linked with performance of the medicine. So as a consequence, Red Bull became something interesting. I don't like it, but it's famous now. I mean, in many regions. So we need to be careful about the application of the AI on behavior, on the behavior of the customers. Make sure that I think we're still a little bit far from having something that would work. We know that 82% of projects on AI fails today, right? Mm-hmm. So it's a high level of failure. And the reason is most of the time we look at the engines, and in fact, the issue is before. The issue is understanding the problem first, understanding the customer first, understanding decision maker first, then you can apply the AI tools, etc. So yeah, this is my point of view on this particular question.
Klaus, so from the technology standpoint, what do you think is the solution? How to make AI less biased, and how can we use that knowledge for across industries?
I'm usually a big believer in technology solutions, and in this case, however, I think I need to add a bit of a cautionary remark as well, because the moment you start saying, as an insurance company, we are using psychometrics to evaluate what users, let's say, post on social media and do other stuff in order to assess the risk, I think you're immediately falling into a trap where the customers will say, oh no, that's not yours to do, and I'm not going anywhere near it. Now, of course, you could do it in the background without people knowing it, which makes it even more devious, and when it comes out, it's even worse. So I think rather than fixing the technology so that it works accurately, in this case, you'd have to take a step back and ask, what is it that we are really trying to fix here? And are we getting to such a fine-grained risk assessment that we make it completely personalized, which I think most people would really object to for good reason? Or are we trying to use technology to automate menial tasks and do robotic automation of things that humans are just too valuable to do, in which case I'm fully on board, and I think everybody else is too, to say if it's about evaluating forms and making it faster and making it easier, collect images faster, like Eric pointed out earlier, that's all great stuff. That's great use of technology. Once you get into psychograms of people and all that, the scary thing is all the information you would need for it is available. And that's where I slightly disagree with Anouar. It's probably actually possible to make it work. And that's actually the scary part. That's why we shouldn't do it. One of the questions you always need to ask about technology is not just, can it be done, but also should it be done?
Right. Eric, so I would be really interested to hear your opinion, especially since, right now, a lot of companies, they're trying to use predictive modeling to underwrite their risks. And so the rhetoric and, among the regulators is that it is biased. So are there any procedures? First of all, have you seen or, any filings that came with a clear explanation of how a carrier is using machine learning to achieve their results? And how would, let's say, state insurance commissioner test these models or to make sure that they're not biased?
Well, thank you for the question. First, I'd like to say that I agree with Klaus. there are certain times that you might not want to use technology to do something that you don't know what the impact is going to be. Given that, there's been a lot of use of artificial intelligence in the insurance sector. And in fact, the regulators use artificial intelligence in evaluating the financial solvency of insurance companies and in evaluating their market regulatory practices. Let's take an example. You mentioned a filing. Up until the mid-1990s, the rating plans for auto insurance companies were relatively simple. I could go to a shelf, pull off a State Farm manual, calculate the price that they were going to charge for some individual, and verify that they actually did that in accordance with the things that they'd filed with the state. In the mid-1990s, the first sort of artificial intelligence activity came into play, and that's credit-based insurance scores. So there they were using algorithms that included various elements of a credit score to develop an insurance score. And that's generally things that are within the control of the insured that are fed into that. So if you pay your bills on time, you get rewarded. If you don't, you get penalized. That made sense to regulators. Now they've gone to these fairly complicated multivariant risk measurement algorithms. And this has presented some challenges for regulators because they are in the US required to file the things. Companies have a lot of investment in the intellectual property and don't necessarily want their competitors to see it. So you have to work with the regulators on how do you get them to take a look at it. The regulators, some of the regulators have experts on staff. Other regulators use actuarial firms, law firms, insurance consultants to take a look at these filings. And what they're trying to measure essentially is whether any of the factors you're using introduces an element of bias. Now, I like to use the ludicrous sort of obvious example of a person subscribing to Ebony magazine. Okay, generally, Ebony magazine appeals to Afro-Americans. So if you use subscription to Ebony magazine in your algorithm, the regulators are going to go on tilt. They aren't going to allow that. But that's the sort of subtle thing that they're going to be looking for with all of the data elements. So the first thing the regulators do is gather the data elements that the insurance company is planning to use to measure risk and go through kind of a conversation with them about, why do you use this factor? What do you expect to learn out of this? How come it's related to risk? So they will do that kind of testing on these algorithms. This does create some issues because it's generally the larger insurers that can afford to use these, though there are now some of those service providers that are providing those to other insurers. But in general, that's what they do. They're looking for tests of unfair discrimination. Does this affect a national origin? Does this affect an ethnicity, a race, any of those types of things? And if they do, they'll prohibit them from using those particular factors, but let them use the ones that seem to make rational sense and are measuring risk at a more granular level.
Very interesting, thank you. Actually, I wanted to bring up the example of Flu Tracker. Back in 2013, Google developed a technology that was supposed to track the pandemic, the flu pandemic, and it was a great failure. And because again, they realized that all sorts of algorithms are created by humans, and humans they have certain idea about the technology, they have certain idea about the correlations, and so it was not a true AI, right? So how do you think, and Les, we've touched on that earlier, do you think that, and Klaus as well, do you think that there will be a technology that can ultimately help us predict pandemics like COVID in the future? Do you think, because we already had a negative experience with Flu Tracker, so do you think companies will be open to invest in such technology? And Klaus, probably from you, I would like to hear what is needed to make sure that the machine learning algorithm truly can navigate through the variety of factors and utilize all sorts of mediators and moderators when we are thinking about any sort of relationship between variable A and variable B. I will go back to Les. So how do you think that the companies are going to behave, and do you think anything like that will be created in the future?
Yeah, Layla, I actually think that the capabilities are already there. From the company perspective, if we just look at what Apple and Google did when they partnered together, which is they don't partner together on a lot of things, when they had this tracing app that they launched. I think since then it wasn't really successful. They tried it for I think a little over a month, but basically it was a way, without concealing the identity of the person who was infected, to basically contact via a unique user ID who had come in contact with a person who had COVID. And what's interesting is millennials and all the folks, I'm a Gen X, so all the folks after me, they're used to sharing their information and used to sharing their data. So I think from a consumer perspective, I don't think that these consumers would balk at that. And I think that's a perfect marriage between the Apples and the Googles and the Amazons of the world saying, oh, we have a willing consumer who's not going to balk at this, and we would like to implement these changes. It's a perfect marriage, and I think something like this will ultimately be done. However, and by the way, with the rise of biometrics, when you have your Apple Watch and all the ways that you can track your breathing and your heart rhythm and everything, you're going to be able to track more pandemics in the future because of that. When you have all this big data out there, and if you're seeing a certain population, let's just pick on Seattle, for example, all of a sudden heart rates are going erratic in Seattle during this certain neighborhood. Uh-oh, something must be up. That means that they must have XYZ condition. Let's go in there and get some health experts in there. The real holdup, I think, in all of this is going to be on the regulation side. I think that, and by the way, for reasons that we mentioned beforehand, there's good reason. You have to have checks and balances, but I think regulators are going to be in certain, associations for the protection and privacy of data. That's where I think the holdup will be. All the Gen Xers, or the millennials and the Gen Zs, they're going to love it because they're connected to everything. You see around, people are walking around like this on their phones all day long. They're going to love it. The big tech companies are going to love it, but I think the regulators will be the ones to, as they should, slow down and do a lot of fact checking before something like this is launched on a global scale.
Okay. Interesting. Klaus, what is the future of AI, do you think? I mean, how to make it less dependent on human knowledge and more dependent on its own experience?
Yeah, that's actually where the interesting part comes in, because what Les just mentioned is essentially the fact that contact tracing is almost trivial. It can be done relatively easily even today. There are questions, should it be done? And a lot of people, including myself, will raise an eyebrow on that. But we're not done when we know who had contact with who in order to figure out, is there a risk of a spreading epidemic on any level? And it's not just the ones like this one right now. I mean, there's plenty of others who could be a risk in the future. If you look back, we've had plenty of epidemics in the past. And the real question then becomes, how do you get the epidemiology knowledge into this? With every new thing that comes, you've got people struggling with, how does this thing exactly work? In the current one, we don't know yet. We even at this late stage, we still don't know exactly how it spreads. There's multiple models being built around it, and they keep getting invalidated because the data doesn't seem to match up with the theory behind the model, which proves that the hard part is not tracking the movement of humans. That's close to trivial. The hard part is modeling how the virus moves, because it's not easy at all to observe. And even if you have perfect data, which in most cases we won't have, it is very hard to verify the model against any real data. And that's where the real challenge is. And any technology in the world doesn't really do much about it until the humans get a first stab at what is this thing really like? What's going on here? Then we can model it, but then it's probably over. At least we hope so.
Right, interesting. Ladies and gentlemen, we actually just reached the end of our official panel. It's 1 o'clock here on the East Coast. And the idea is that we will jump into questions and answers from the audience. So I will ask our dear attendees to ask any questions you have. And then while we're waiting, we will continue our conversation among the speakers. And so going back to everybody here, so if you have any questions to each other, please go ahead and ask. I think that would definitely make this panel very interesting, especially because we have representatives from different companies, from InsurTech, from the regulators, from brokerages and technology and aviation company. So don't be shy and ask questions as well among each other. But I do want to speculate a bit more on AI, because a lot of companies, and again, going back to the first point of our discussion when last mentioned that there will be a lot of mergers and acquisitions, I'm seeing that a lot of companies here, like in the insurance industry, they are trying to find a quick fix to their problems, and so they are looking for product companies that are already offering out of the shelf, essentially pre-built solutions, claim management systems, or underwriting policy management systems and things of that nature. So instead of actually developing their own, they are purchasing or buying out or investing into these product companies. Do you think, and Klaus, I also would like to hear your opinion, what are the challenges from technology standpoint when acquiring a company and integrating it into your own infrastructure versus building something of your own?
Wow, that's a huge question. And what are the challenges? Again, that's a long list, but the things to watch out for if you're trying to make a decision, should we buy or should we build, is not just the cost. There's the old-fashioned way of looking at it to say, if I buy it, it costs me X amount of millions, and if I build it, I have my project plan and I know how much that costs. It doesn't end there, because you've got an integration cost, you've got opportunity cost if you put people to build something that could be used for something else. So the picture is much more complicated than that. And the decision about it is very often made in emotional terms, because people see some competitor coming up behind you. We need to buy them before they get too big. Or they see that somebody is doing something and you're thinking, oh, I could do this much better if I only had 500 engineers, and you start hiring and you start doing it. Those are emotional decisions, and they shouldn't be made like that. You should be more rational about it. You need to compare what the two plans look like, and you need to get deep into the integration problem. That is most likely the biggest cost factor and the biggest time sink.
Interesting. Do you see any challenges to this strategy from the regulatory standpoint, Eric?
Well, it's a build or buy a solution, essentially. As long as the solution is appropriate, legal, working well, the regulators don't have much issue of you buying. They get into issues where it becomes an antitrust issue, where if State Farm decided they wanted to buy Allstate in the US, that would be an issue because they're such major players. But when you get to a buy or build situation, there's lots of examples of tech companies that started up and had a good idea. WeGoLook is a good example of that. It's essentially, it matches people with certain skills to skills needs from somebody on the claim settlement side. Crawford and Company bought that after a while. and integrated it into its system. So now all of the Crawford claims representatives have access to WeGoLook. Now, WeGoLook it doesn't require licensing because it's sending people out to take a picture, sending people out to deliver some papers that need a wet signature, that kind of thing. But there are many opportunities in the insurance industry for innovation to affect the way that things have been done. Starting with paper delivery of a policy form. That's all been automated by most companies at this point. So you can choose whether you want to get your contract through the mail or you want to get your contract over your equipment. And there are endless areas in the insurance world that are ripe for innovation because they have legacy systems. Many of them are starting to move away from those, but that's a huge lift and very expensive for a company to do. So if there's a startup that is going to be cost effective and is solving one of the problems that they have, then why not use that startup if it is cost effective? So we are seeing a lot of that activity where the former viewed as competitors are now partners and moving forward that way. So I think there's a lot of that going on in the insurance sector.
Eric, do you think there's been a lot of regulations lifted, especially in mid-March to April, for truckers, when truckers were going around the United States delivering things, the amount of time that they could be on the road versus the amount of time they had to rest was lifted, and also some of the speed limits were kind of relaxed in certain areas. So these toilet paper and paper towels come to mind, right? Goods that can be sent to grocery stores. So are you seeing some companies that are saying, let me take advantage of the fact that we're in this weird, new, never before seen environment? Let me now buy this other company I always wanted to buy, but I'm going to tell the regulators, though, it's for the good of the American public safety. I'll just give you an example, Uber and Postmates. I know that there was not a big, I don't think the regulators really pushed back on that a lot because it happened, rather quickly. But one could argue Uber could say, look, regulators, by us combining our platforms, we can deliver food to Americans quicker, better, faster, and that's needed, especially because nobody's going out to grocery stores. Do you think that we'll see a wave of this consolidation under the guise of this is for the American people? We have to do it.
There may be some of that. That's an example that's really outside the insurance sector. But I could see things like that happening in the insurance sector. I mean, someone mentioned earlier that the insurance companies selling personal auto insurance have got like a bushel full of money because people aren't driving. The sharp ones went on TV and said, we're giving a refund. Now you see ads, every auto insurance ad you see on TV has, we're giving our policyholders 15% or this, that, or the other thing. For this period, and it, for particularly the first movers on that, got a huge uplift. Because you're sitting at home and watching this, your neighbor's insurer gave him 15% or sent him a check, and now you're going, well, what's the matter with my insurer? And eventually, your insurer gets around to doing that, but the first movers got a lot of good strokes for that. So there are going to be examples like that where that kind of activity will take place and may increase in this period. And it's kind of unknown how long this period is going to last. My best guess is a couple of years, just based on what happened in 1918, 1919. Of course, I was there to witness that.
Of course. Eric, I actually have a very interesting question from Doug Hartz that I think it was addressed to you. So the question is, in using machine learning, if it adds an underwriting variable, because it determines such variable will be predictive of risk, how is it explained to the company that is utilizing AI and to its regulators?
Well, an explanation of 1,000 variable rating system to the public is virtually impossible. I think agents struggle with that all the time. Companies don't have a good way, and companies, frankly, are hiring these firms that do run the algorithms they aren't entirely comfortable with how it all works. So you see in conversations with regulators and companies where they're bringing in a third-party firm to explain all this stuff and actually taking a look. And once again, the insurance regulators are interested in if it, one, accurately measures risk, and two, if it does it in a way that is not considered unfairly discriminatory in any of the factors that it uses to measure the risk.
Gotcha. Thank you. Another question from Claudia Lynn. What are the innovative ways the commercial insurance distribution channels, like wholesale versus retail, could be disrupted by using AI to gather and analyze clients' insurance programs and structure ideal marketing for the clients?
Well, that's a good.
I might jump on that one. I do think one of the things that we've started to see, certainly in the insurance business, is the way that insurance is distributed is really revolutionizing and changing. And the way that it's changing is actually what brands are actually representing insurance. And one of the things that's becoming more and more true is the brands that consumers think about are not necessarily insurance companies. They might purchase their insurance similar to like travel or warranty. It's kind of a point of sale. So for example, a lot more you see if you show up at a car dealership, they're going to have, car insurance brought to you by, let's say Progressive in the US or Admiral in the UK or Allianz in Germany. And they're the ones who underwrite the policy, but the brand is white labeled. So if you're at a car dealership at let's say Jaguar, you're going to get a Jaguar policy, and it's going to be a part of an app, and that app is going to have more than insurance in it. It's going to have maintenance schedules, it's going to have abilities to interact with your financing, and there's going to be this bundling of services that you get with a brand, and every single brand is going to have a unique type of insurance that they're going to want to offer based on the service that they just offered you. So if you're showing up to buy a home with a bank, that bank's going to offer you probably home insurance along with a mortgage. If you're showing up to buy a car, you get your car insurance. If you're showing up, at a vet might distribute you pet insurance. So similar to these other points of sales, you're going to get this bundling of services, and insurance is going to become a part of that. And all of that is a part of a digital distribution or a digital interaction with the consumer. With how that relates to AI, I think how you're maybe rated is probably part of it. But I think customers are more and more probably opening up their minds that there's a convenience to just buying what you need at that moment if you're confident that the price is fair. I think there's always a little bit of a race to a bottom. There's the aggregators. But if you're comfortable with the brand that you're working with and you really have a strong, let's say, net promoter score with whatever brand that's delivering you a service, if they're offering you insurance and it's convenient and it's presented to you in a way that's really slick and interactive, that a way that you expect as a consumer, you're probably going to buy it. And you're not going to worry that you're paying maybe 10% more because it's just a part of a broader offering that brand is providing you. So I think it's really interesting on the underwriting side. I think it could be started market, people could pick up on that. They could market to you or remarket to you. But I think that the brand loyalty is going to change. And we're seeing that evident, certainly in the OEM space, definitely happening across a lot of other personal lines as well.
Absolutely. And, there are a couple of insurtechs right now that are trying to come in and sort of act as brokerages that provide policy comparisons and in different product lines. And so a couple that I can think of, it would be probably InsurFi or Policy Genius or CoverHound, different product lines. But the question is, and it's actually coming from the audience, are the algorithms unique enough to differentiate and compete and eventually replace human expertise? Since we were talking about adoption of the AI and in the future, and I think, Clive, because you had to compete, because Trov had to compete a lot on the market with other insurtechs, I would like you to give to comment on that as well.
Sure. I think certainly it goes back to some of the other points that the panelists have made. I think there's a question of also, is it a good thing that you're being rated by AIs? I think there's going to be an element of, we certainly saw a breakdown of agents with the aggregators where you could go online and present that information. So I think there certainly is a trend. I don't think that it clearly has already happened. I think where it gets to be a little bit more of a challenge is a question of, is everybody thinking about their insurance as a race to the bottom? Is that truly what consumers really want? I think the aggregators definitely create a more seamless way for insurance to get to the consumer. And I think that's what's most exciting trend, is that there's different offerings and ways insurance is being presented. And certainly, I think to what degree do humans get replaced, I think is a very difficult question, because the regulatory biases come up, and also our unintended consequences happen because within the algorithms. So there certainly needs to be some oversight. I think at the end of the day, consumers are going to expect to see things or marketed to be them in a way that they enjoy, either interacting with a brand they know or a channel like an aggregator that they're used to.
If I might add, I agree with everything Clive said, but I think this is likely to be more prevalent in the personal lines, where auto and homeowners policies, you have at least the possibility of using AI to match the risks of everyone, because driving a car, if you drive a Lexus versus a Yugo, that's going to be reflected in the rates, but it is possible to have AI use all of those elements to get a price for a person. When it comes to commercial lines, I think the businesses, other than the real small businesses like your corner grocery store, there are so different when you particularly get in the manufacturing world, that developing an AI for somebody that makes a particular product might be very cost ineffective for an insurance company, because that's the one business that does that particular product. So I see it being more probable on the personal line side than do on the commercial lines.
We're a little over 1 hour and 15 minutes. And if you don't mind, I'll ask you just one more question from the audience. We have a question from Ahmed, who is saying that, yes, you can implement AI for cross-sale, upsale, but there might be an issue with servicing. A lot of digital insurance products or companies, they're experiencing issues with servicing of those products. There are some consumer learning opportunities to take advantage of. What do you think would be such a lesson for an InsurTech company?
I think one of the lessons, I'm going to take you back to my days as an engineer at Ford. I was a foreman on an assembly line. We were making engines for the Ford Ranger, and there's about 15 different stations. Everybody was great. One would stuff the pistons, one would put the cylinder head on, and the line would be slowly moving down to ultimately manufacture this engine. Right now, I see this is how insurance is done, where you have Jake from State Farm approving or denying any type of claim or any type of an insurance policy to an individual. That's good from the standpoint of at least the person can talk to a Jake at State Farm. Where I see the future going is, now you look at some of these assembly lines, not just in the auto industry, but in manufacturing in general, where you'd have 15 people, you'd have 1 or 2 people, and there would be 15 different stations. And that person is highly skilled in how to operate the machines that are doing the job that 20 years ago, somebody was, stuffing pistons manually by hand. It's all being done. It's all automated, but you still have one person to do, if dare I say, fact checking, making sure that the product that's moving down the line is actually up to specification. And every 10 minutes or so, you may measure tolerances to make sure that the machine is doing a good job doing what it has to do. I say for what InsurTech companies could learn is that you don't want garbage in, garbage out. So yes, your algorithm is approving or denying claims or approving and denying policies, but the humans behind it, when they're getting these, stamp of approvals to yes, the claim is approved or yes, the claim is denied, just making sure that that operator understands how to analyze the data. Just like when I was in engineering school, yes, computers can do all the work and spit you a number, but does that number make sense? What are the qualitative aspects behind the job that you're doing? So I still think we're going to need humans behind this data that's being put out. Probably not as many, because the volume can be done much quicker through algorithms, but you're still going to need humans to approve or disapprove any claims or any insurance policies.
Absolutely.
Yeah, and that's particularly true when you talk about kind of the garden variety claim versus a more exotic claim. On the auto insurance world, if your bumper's dinged up, they can get that handled with little or no human intervention. If you end up with a complex auto claim where you're trying to figure out whether the person is 50 or 51% at fault, you're going to have a human involved.
Yeah, and I think building on that too is one of the things that improves the operations but doesn't necessarily remove the humans is when claims come in, AIs are reading what are the notes, what was the initial, let's say, notes of the situation, and let's just say the fact gathering. So there's incredible things happening, with first notice of loss, where telematics in the vehicles or connected cars are gathering loads of information to paint a picture of what really happened with the accident. Then you combine that with notes of what did a human say. And when you take that in aggregate, one of the coolest AI things that's happening in claims organizations is they're actually becoming traffic cops. So they're saying, oh, I've now gathered this. I assess based on previous interactions on a scale of 1 to 10, how complicated is this? And then, if it's extraordinarily complicated, it goes to the most sophisticated claims handlers to review it. If it's middle of the road, it might be a more junior claims handler. And at the end of the day, it arrives at a human's desk, but there's a difference or an efficiency level that, maybe your most junior claims handlers aren't having to wait 3 days to recognize, oh no, this is really complicated. I need to take this to my supervisor. And in those 3 days, a lot can happen in the claims life. So I think there's also an element of, it doesn't necessarily replace humans. It does the best thing, which is makes the organizations more efficient. And that's actually a benefit, truly a benefit to the consumers and to regulators and the insurers. It benefits the entire ecosystem.
Thank you very much, Clive. I think it all comes down to as well that we have to remember that innovation comes in different shape and sizes. And when we're talking about, be it in aviation or insurance, there are companies and products that aim to evolve and help standard companies and enterprises evolve, and those that are trying to disrupt the market. And I truly think that both have the right to exist, and I'm looking forward to see where we all are going to end up in insurance industry, in the aviation industry, and many other industries, and with all of the technologies that we have right now and flirt with nowadays. I want to thank all of the panelists, my dear guests. It was such a pleasure to talk to you, to hear your wonderful experience, your thoughts. I'm sure that you managed to inspire and answer a lot of questions that our attendees had. I do want to again thank my company, ELEKS. That is one of the most innovative companies I've been working with and for in my life. So thank you for all the great work you're doing. I'm looking forward to many more events, and if you have any questions, feel free to reach out to us. Feel free to reach out directly to our wonderful panel guests. On our LinkedIn page and our Facebook event page, you have links to their LinkedIn pages as well. So feel free to reach out with any of your questions, business opportunities, and all sorts of interesting initiatives. Thank you again, Eric, Les, Clive, Klaus, Anouar. It was a pleasure to moderate this session. I'm looking forward to staying in touch and to many more successes in your business and ours.
Thank you very much.
Thank you, Layla. Great job.
Thank you.
Yeah, thank you.
Thank you.
Everybody.
Bye.